There are hallmarks through this pandemic that you remember, and one of us was in the depths when it was really ugly out there with Jan Hatzius of Goldman Sachs as he appeared tireless from the Goldman Sachs offices. Really, I think the first economist to get back, and in honor of Dr. Hatzius, I go tireless for this good conversation. Jan, I want to talk about where we go from the jobs report, from inflation tomorrow, where we go from retail sales on Friday. How do you assume you will readjust, or in the way that you will recalibrate your GDP forecasts?
Well, we have recalibrated to some degree the pattern of job growth. Friday was, far below expectations, obviously, and I think there is a good argument that it's just hard to see these really high seasonally adjusted numbers in the months of the year when the seasonals are looking for big increases. There's a lot of seasonal hiring at this time of the year. I think it's quite plausible that employers maybe prioritize post-pandemic hiring over seasonal hiring to some degree that then shows up as weaker numbers. That's still going to be with us, I think, for the next couple of months. But the flip side should be stronger jobs growth numbers than we previously thought later in the year. So on payrolls, I think some adjustment was warranted. On GDP, we haven't made any changes. We still think Q2 is going to be probably the peak growth rate. We're a little over 10.5%. So it's a very rapid pace of growth in Q2. But then I think it does probably slow down somewhat after that.
How do we adapt to a Jeff Curry commodity boom? Dr. Curry has been way out front on talking about the inertial force of metal prices and others as well. How do you adjust your GDP oomph, if you will, to what Curry talks about?
Well, I think it's not clear that it has a major impact on GDP. I mean, I think there are positives and negatives from changes in commodity demand supplies. In some areas it's positive, in other areas it's negative. Clearly it is a reason to expect much higher inflation numbers in the short term, and that's particularly true for headline, but it's true to some degree for core as well. And I think over the next couple of months we will see significantly stronger inflation, 2.5% for core PCE, maybe 2.7% in May for core CPI. And I do think that is probably one of the reasons why the markets are having a difficult time at the moment. We've had some weaker numbers on payrolls. At the same time, the highest inflation numbers are just ahead of us. I do think, though, that ultimately it's going to be more temporary. A lot of the drivers of inflation, not just the commodity numbers, but also things like the base effects and some of the impact of reopening on service prices, a lot of that is pretty short term. Doesn't really tell you a lot about inflation in 2022, when we think we'll probably be back to about 2% for core PCE.
Yeah, and just in the meantime, this was the take from Mike Wilson over at Morgan Stanley, who said disappointing employment report from Friday suggests labour availability may be a gating factor on the speed of reopening. What's your reaction to that?
I think there's probably something to that. I mean, I do think that there are some signs that labor supply is more constrained, not only the weaker jobs number, but also pretty high wage numbers, especially in Friday's report, high vacancies, relatively high quit rates. And so I do think that, for example, the $300 per week extra top-up unemployment benefit probably is an issue in some areas, especially low-paid industries. However, it is fairly temporary because it's scheduled to expire in September. If this was still going to be on the books for, a year or two, then I think it'd be a much bigger concern. But it will diminish, as will other reasons for, more constrained labor supply, namely fear of the pandemic and the fact that schools in many places are still not open. So all of these things, I think, are going to get better a few months down the road. So
clearly, Jan, you don't think that the supply side issues in the labour market need to be addressed with higher prices, higher wages?
Well, I think they might have some of that impact in the short term. My point is just that, especially if I look at this as a policymaker, I'm going to care more about the medium term. What does this tell us, for example, about inflation in 2022, 23, et cetera. And I think there the significance is really more limited.
Jan, there seems to be a mystery on pricing powers. Revenue on the corporate statement is unit dynamics and price dynamics. I know it's a study from ages ago. Maybe you're going to do a Friday note on it. But are we going to see pricing power from corporations?
Well, I think to some degree, we are seeing it in the PCE and CPI numbers. There are some increases. I mean, clearly in the service sector, if you're an airline, you had no pricing power a few months ago. You clearly have more pricing power now, and I think that's not yet really shown up in the numbers, only to a small degree. So we'll see more of that. But so I do think increases in prices in a number of areas are going to correspond to more pricing power. The question is just, is it a short-term issue or a long-term issue? And again, I think it's more short-term.
I look, Jan, at the path from Bill Dudley to Jan Hatzius, and of course, the former chief economist for your shop, writing a wonderful essay for us. And he really talks about the inertial force once rates get going. I don't want you to compete with Bill Dudley, but I'm curious what you think about the momentum of rates moving higher once they finally move.
Well, as often, and of course, Bill has been a great mentor. As often, I basically agree with the idea that this is going to be a later, but probably somewhat steeper tightening cycle. We don't have any hikes in our forecast until early 2024, despite an optimistic view on growth. But we do think that, once they get going, maybe it's going to be slow at first, but ultimately we'll see probably more rate hikes than what's currently priced. In his article, Bill points out correctly that the market currently is priced for a terminal funds rate of about 2%, and I do agree that that the actual level is likely to be quite a bit higher. The Fed's saying 2.5% for the longer term funds rate, and if they wait for a long time because they really want to be sure that the labor market's at full employment and inflation is going to be above 2%, then probably they're going to have to go above 2.5%. In the end.
What's quite a bit, Jan? Quite a bit higher. Bill Dudley says 4.5% as a peak. Not out of the question. What's quite a bit higher for you?
Well, so I would say more than what markets are pricing. I think 3% would be a little bit above the, 50 basis points above the Fed's current estimate of the longer term funds rate. Could it be in the, low to mid threes? I think that's possible. I mean, it's hard to, have a strong view on something that is a number of years away, but I do think it will be above what markets.
I'm just wondering, Jan, how we tolerate that in an economy we've just added a ton of debt to. How would we tolerate a rate of Fed funds of 3, maybe 4, according to Bill?
I think it depends on what else is going on in the economy, and if there is a strong bid, for example, from governments still running larger deficits than in the pre-pandemic period. I think that would mean that the government is basically demanding more savings. The private sector then has to supply that savings, and that may require somewhat higher rates than what you had in the previous cycle. I again want to emphasize that a lot of these things are pretty far away. I mean, in the near term, I actually have a more dovish view on where the funds rate is going to go than what markets are pricing. I think the Fed's going to get started later than what's currently in the market. But I think a lot of things can change on a horizon of 3, 4, 5 years.